Good morning. My name is Joseph Litschauer, and thank you very much for taking the time to join us today for our Ideas for Your ISA event. Today, we'll be hearing from Long Lin, the Senior Investment Director from WhiteOak Capital, the Investment Advisor for the Ashoka WhiteOak Emerging Markets Trust. Long will provide us with a bit of an update on the trust, but also his insight into the opportunities that both he and the team are seeing currently across emerging markets. Before handing things over, I'll quickly run through our plan for today, just for those new to the format. Long will present on the trust for around half an hour or so, and then we'll move on to around 10 to 15 minutes of Q&A. So if you do have any burning questions that you want me to put forward, please just pop them into the Q&A box in the bottom right-hand side of your screen, and we'll get to them at the end of the presentation. So with that, it's my absolute pleasure to welcome you, Long. Please take it away.
All right, thanks a lot, Joe, and thanks everybody for taking the time to be with us today. So I'll quickly give you a brief introduction into WhiteOak, who we are, and the Emerging Market Trust. So WhiteOak was founded by a chap called Prashant Khemka back in 2017. Prashant was formerly at Goldman Sachs Asset Management, where he ran both the India and the emerging market portfolio. Won't go into too much detail, but suffice to say that during his tenure at Goldman across both the India and the emerging market strategy, Prashant delivered top decile returns. Since launching the emerging market strategy in June of 22, initially with an ICAV, he's continued that performance record with top decile returns. In terms of the structure of the trust, just briefly, we have no fixed management fees, so we only take a performance fee on alpha generation. And that performance fee is also paid in shares, and half of it is locked up for 3 years. So in terms of alignment with our clients, we're trying to get it as high as we can. And there is also an annual redemption facility to protect investors against this trust trading at too much of a discount. So then going quickly on to the team. So I won't touch on this because this is more about Prashant. So here, these are the 4 pillars that underpin everything that we do. We think the team, the philosophy, the balanced portfolio construction, and our proprietary process are the 4 things that combine to help us deliver alpha for our clients. One other thing to point out on this slide, because we'll jump into everything here in a little bit more detail, is over here we talk about a performance first culture. And first, that means 2 things. One is, as a boutique asset manager, we live and die by our performance. So we're very much focused on maximizing the alpha we generate for our clients. The second thing here is we don't just aim to be slightly above the benchmark, be in the top half of our peers. We aim to be the first in everything we do, and that includes being the best performing fund or trust for our clients. In terms of the team, now what you'll notice straight away is that this is a very large team. So if I go to this slide here where you can see in a little bit more detail, essentially what you see here is in this darker gray color here is everybody who looks at emerging markets ex of India, and everybody here looks at India specifically, given our strong track record on where we started. Now, there are a couple of things to note. The first thing is, why such a large team? As you know, this investment trust, we tend to focus on the small mid-cap part of the market. Now, the small mid-cap part of the market tends to be a lot less researched, a lot less covered by the sell side. So you have to go out there and do a lot of the primary research yourself, go kick the tires. And that tends to be very resource intensive. So only by having a large team do you have the resource available to do the work that you need to get done. The second thing that we do, you'll see that a lot of our peers tend to have one analyst covering one sector or one company, for example. We prefer what we call a team within team approach. So rather than have one analyst cover a sector, we usually have a small team of analysts that covers each sector. The benefits of that, one, like we talked about earlier, it's that ability to go deep into companies, especially the small mid caps. But the second thing it helps to do is it helps to mitigate some of the biases that individuals have. So we tend to come to a slightly more balanced or more well thought out idea when we fully present it to the rest of the team. In terms of how the team is situated geographically, a large part of the team is in India, another large part is in Singapore, and a couple of our colleagues are also based in Madrid. How we go about coverage, we tend to be quite pragmatic about it. So some sectors, if you think about it like autos or healthcare, they tend to be quite global in nature. So there's one single team that would cover India, Asia, LATAM, all from one location. Whereas other sectors such as industrials or maybe consumer staples, they tend to be slightly more regional in nature. So our colleagues in India would cover industrials in India. In Singapore, we would cover Asia ex India. In Madrid, they would cover LATAM, Eastern Europe. So that's how the team structure largely is. Now, in terms of the investment philosophy, we like great businesses at attractive valuations. And you've heard that a million times before. So, how are we any different to anybody else out there? I think it's one thing to say it and know it. It's another thing to live it and do it day in, day out on a disciplined basis. So, for example, if I asked you, oh, what does it take to be healthy? You'll tell me need to exercise, we need to eat well, probably drink less, sleep well. And we all know these things, but how many of us do all four of those on a kind of day in, day out basis? Probably very few of us. And it's similar with this. Now, great businesses, what we look for, it's nothing controversial. We look for companies with superior returns on incremental capital, basically companies that are creating value for their shareholders. And we look for scalable long-term opportunity, meaning there is a way to compound that value that they're creating for their shareholders. Maybe where we're a little bit different is we put a very strong emphasis on management execution and their track record, and also governance. Because we're long-term investors, when we invest in a company, we think about it as partnering with the management team. And simply put, we don't want to partner with a bunch of crooks. Now, valuation is where we're a little bit different. So we focus very much on cash flows, and we have our own proprietary valuation framework called the OpCo-FinCo model. So this is what the OpCo-FinCo model looks like at a high level. I won't go into this in too much detail here. We can cover it in Q&A if there is interest in it. But essentially what it does is it normalizes for capital intensity and capital decisions that a management team might make. And instead, it focuses on the operating side of the business where the actual value is being generated. And we think by doing this, one, it normalizes for accounting issues, it normalizes for capital intensity across sectors and across accounting treatments. So it enables you more accurately to compare apples to apples. And it enables you to assign value to the right part of the business, giving you a much more economic version of valuation rather than an accounting version of valuation. So you won't hear us talk about things like price to earnings or EV/EBITDA very often. Instead, you'll hear us talk about asset light multiples or cash flow multiples. So going on to the investment process, and how we come about with the portfolio, essentially we like to run a very well-balanced, well-diversified portfolio, which at any point in time should have over 100 companies in it. Now, if you remember, we like great businesses at attractive valuations. So there are probably about 700 great businesses, we think, within our investable universe at any given point in time. So the ones that have both the great businesses attributes and the attractive valuation attributes are what make it into the portfolio. But we're always looking for new ideas. So companies that might not be great businesses today, but are showing signs of maybe becoming great businesses, etc. So these are the kind of things that we look for when we're building the portfolio. In terms of portfolio construction, it's quite simple for us. We just have two goals. Goal number one is to maximize the alpha that we generate for our clients, and goal number two is to minimize the volatility with which we deliver that alpha. Now, how do we do it? We think that our edge, and the only sustainable edge that we have, is through stock picking. We don't think that we, or maybe anyone else out there, has the ability to consistently call macro correctly on a long-term basis. So for example, we don't try to position the fund to take advantage of things like interest rate moves, US dollar moves, elections in a certain market, maybe certain sectors, cycles turning around. So we don't think we have the ability to call that. So for us, rather than being an opportunity to exploit, those things I just talked about, those macro events, to us, they are factor risks that we want to try to avoid in the portfolio. So if you successfully mitigate all these different factor risks, all that should be left in the portfolio to drive performance is stock selection. And that's what we aim to do. So how do we do that? Okay, so we focus on what we consider are the alpha rich parts of the market. So an alpha rich versus an alpha poor part of the market, what that means to us is an alpha rich part of the market is simply somewhere where we find more of these great businesses at attractive valuations. An alpha poor part of the market, conversely, would be where we find it harder to find these great businesses at attractive valuations. So to give you an example, if we take market cap as a spectrum, now we all know the literature. We know that small mid caps is a less efficient part of the market and large caps are a more efficient part of the market. So therefore it follows naturally that the small mid cap space would be alpha rich for us and the large cap space would be alpha poor. We're not, this is very important here, though, we are not taking a view on which part of the market will outperform in general. So we're not saying that small mid cap will outperform large cap. So all you have to do is go overweight small mid cap. What we're saying is simply from a bottom up perspective, we are more likely to find great businesses at attractive valuations in small mid cap relative to large cap. We think if you blindly invest in the small mid cap space, you're actually going to be taking on a lot of risk for your clients. And that's why, again, going back to that team that we have, we're uniquely set up to extract as much alpha as we can from this alpha rich part of the market, but we don't do it blindly. So where else do you find good opportunities? So if you think about alpha rich and alpha poor, there are other ways to split the investment universe. So if we talk about companies with good governance versus poor governance essentially inserts a random variable into the valuation of a business. Because if you think about it, a company where you're not confident that management will distribute the cash flows fairly to minority shareholders, where they might extract value for themselves, that tends to be something you cannot really fundamentally analyze. So it tends to add a bit of a random variable in that. So to us, that would be an alpha poor part of the market. Macro variables we've already touched on. You could pick the best energy company in the world, but if the oil price goes to $20, it's quite clear that that company's share price will suffer, and we don't think we have any insight into where the oil price is going. Regulation, a company that's heavily regulated or a sector that's heavily regulated is less likely to deliver good ideas for us because the government seldom gets involved for the benefit of minority shareholders. And the last one is quite an interesting one. How democratic a country is also tends to impact whether it's alpha rich or alpha poor. So for example, if you take China, which is a very undemocratic country, as we all know, so you could have been the best internet analyst on the street in China. And a couple of years ago, you could have picked any of the internet companies. But what you could not have foreseen is that Jack Ma would say a few things that would really annoy Xi Jinping. And overnight, some policies would come out and internet valuations halve pretty much right on the spot. So that level of unpredictability makes in these kind of less democratic countries an alpha poor segment of the market relative to more, I guess, stable democracies. So countries like India, which is the world's largest democracy, where you see rule of law. I mean, it's not perfect, of course, but you see rule of law generally being pretty well implemented, property rights being fairly well respected. It just gives you a bit more predictability. So for us, that would be alpha rich. So if you take all these different variables that we just talked about and you overlay it with the different sectors, the different countries within the universe, you can see areas like real estate, commodities tend to be alpha poor for us, whereas consumer IT tends to be alpha rich. Now, skip over these couple of slides and come back to them because I want to show you this. So this is what the portfolio composition looks like today. So if you remember everything we just talked about in terms of alpha rich and alpha poor, so where we're overweight in the market, so places like consumer discretionary, places like industrials, this is where from a bottom-up basis, we are finding those great businesses at attractive valuations. So therefore, these are the alpha rich parts of the market. But places like communication services, like utilities, like energy, they tend to be alpha poor parts of the market for us. So again, we are not making a sector call here. We're not saying that we think energy will underperform or utilities will underperform. It's just that from a bottom-up basis, we're not finding these great businesses at attractive valuations in these sectors. We do look all the time, but we do struggle in some areas, and you should expect that to be the case with the investment style that we have. So if we go to market cap weights, again, it should be no surprise that we are overweight small mid cap relative to large cap in the benchmark. And then regional weights here is something that we should spend a little bit of time on as well. So if you look at regional weights, it seems like we're significantly underweight Asia and significantly overweight developed markets. And about this time, you're thinking, but hang on, guys, you're meant to be an emerging market fund. What are you doing? So how we think about the world is such. So if you look at this is our exposure by country. And if you look at it on a country of listing or incorporation basis, it looks like we're significantly underweight China and Hong Kong, significantly underweight Taiwan. However, if you remember earlier, we talked about trying to mitigate macro risks and trying to operate in alpha-rich parts of the market. So China tends to be in alpha-poor parts of the market for reasons we've highlighted earlier. And country level governance tends to filter down to corporate level governance as well. So corporate governance in China doesn't tend to be the best. So what we've decided to try and do is, we still want that exposure to China. We still want exposure to the Chinese consumer, but we don't necessarily want to take on some of that corporate governance risk that we're seeing from domestic corporates. So if you look down at the developed market part of the portfolio, so we own positions in company in France like Hermes and LVMH. So these companies, luxury brands, as you know, have a very large part of their value coming from emerging markets. Actually, it's more than half. And within that, China is by far the largest driver of value for these companies. So by owning these companies, we have that exposure to China, the Chinese consumer, but we don't take on the level of risk that we would by owning a domestic Chinese business. So if you rebase that by country of economic exposure, China actually is not an underweight anymore. We know this is not a perfect hedge, and over time, actually, what you've seen is our reliance on developed market names as a way of playing China has actually come down because over time, the more we go to China, the more time we spend with the management teams of these companies we found. As we get more comfortable with them or find new ones, we can take the capital allocated to these developed market names and actually put it into onshore companies. But a lot of these companies would be in the small mid-cap space, so that does take time to get comfortable. Another way of thinking about it in Taiwan, so this underweight in Taiwan is largely driven by the Taiwanese semiconductor industry. So TSMC, of course, being the biggest, but there are other large companies such as MediaTek out there as well, which are all very large in the benchmark. Now, we like these companies and we actually own them, but to run an overweight to Taiwan, especially that semiconductor segment, would be putting, you have to put over 20% of your client's capital into Taiwan. Now, Taiwan's issue for us, it's nothing to do with the country level or kind of corporate governance in the country. It's more to do with the fact that Taiwan sits across the strait from China, which is run by a single man who has spoken publicly about his desire to reunify Taiwan with China. If that were to happen, that would be catastrophic. We can't predict the odds of that happening. I know it's more than zero. I know it's probably less than 100. But between that, we don't know where it falls. However, a way to get exposure and mitigate some of that risk is if you look down here, we own companies like ASML, ASM International, Disco in Japan. These are all semiconductor capital equipment companies, and their biggest customers are all in Taiwan and maybe in Korea. So again, you get that same economic exposure, but without taking on some of that geopolitical risk. So in terms of the portfolio characteristics, like I said earlier, we run a very diversified portfolio, so 186 names in the portfolio at the moment. On a price to earnings basis, we're more expensive than the benchmark, but you should expect that to be the case. The premium to the benchmark comes down when you look at it from a cash flow basis, again, because we pick companies based on cash flow rather than accounting earnings. But in return for a slightly more expensive portfolio than the benchmark, you get much better growth prospects, you get better returns, so better quality businesses. The beta is pretty low, so what that tells you is by running this balanced portfolio that we have, where we try not to take country or sector calls, you shouldn't expect wild swings versus the benchmark. In terms of the holdings, on the right side here is probably the more instructive chart, so holdings by active weight. What you can see is that there are no single big bets within the portfolio, and it falls away very quickly to less than 1% in terms of position sizing. Two things to note there. One is that we're unlikely ever to see our performance driven by the performance of a single company because we don't like taking big company bets. We want the alpha we generate to be coming from a wide base of companies. And second thing to note is because we have an overweight to the small mid-cap space, we run the diversified portfolio in order to manage that risk. Because no matter how well we get to know a small mid-caps are still more risky by definition. So performance then. So the fund was launched in 2023. So we have a little bit of 2023 performance, couple of quarters, full year 24, and a little bit of 25. So in terms of NAV since inception, we've generated just under 24%. That compares to 16.5% of the benchmark. So some significant alpha there. But if you remember our portfolio construction goals, so goal number one is to maximize the alpha we generate for our clients. So we've generated a decent amount of alpha. We could always do better, but we're relatively pleased with that. But also consistency of alpha. So we outperformed in 23, we outperformed in 24. So far 25, we're a little bit too early to tell. But by and large, you shouldn't expect big swings in performance. So you shouldn't expect us to shoot the lights out one year just to give it all back the next year. The way our portfolio is designed, it's to generate alpha on a sustainable basis, but consistently. So if we delve a little bit further into how that alpha is generated, so if you look at market cap analysis, so what we've done here is taken the MSCI EM benchmark and we've drawn a line through it. Everything above the line goes to large cap, everything below is in the small mid cap space. So there are a couple of things to note. So one is that small mid caps contributed by far most of our alpha relative to the large cap space. Again, that's something you should expect given the alpha rich nature of small mid caps. But secondly, also that selection effect has driven the alpha and not allocation. So it's not as overweighting small mid caps that has driven the alpha. It's actually picking the right small mid caps within relative to whatever the benchmark is doing. So actually, if you look at it on a benchmark basis, in the benchmark driven by companies like TSMC, actually large cap outperformed small mid cap. So we outperformed on the large cap space, but we significantly outperformed on the small mid cap space. Again, if we go to country attribution, India has by far been the largest contributor of alpha for us. I think that's something that you should expect to continue, partly because, like I mentioned earlier, India is an alpha-rich part of the market, but also because of the strength of the WhiteOak team on the ground in India. So WhiteOak is a very large asset manager within India. We have very good access to corporates, very good access to IPOs, and in the trust structure, we can also invest in pre-IPOs, which tend to come in at very preferential pricing. So that is something that we expect to continue. But equally, you can see across many other geographies, we are still generating positive, if smaller, amounts of alpha. And similarly, you can see here that it's also selection effect, not allocation effect. So meaning it's the stocks we are picking within the countries. It's not that we're picking and overweighting countries that are outperforming. So similarly by industry, I won't dive too deeply into this, but you can see that selection effect again, it accounts for the vast majority of the alpha we generated. Allocation effect has been very small. And here you can see that, again, alpha is very evenly distributed across all the different segments, all the different industries that we invest in. So last slide for me over here is portfolio performance. And you can see the top 10 contributors on the left over here, and over here, the top 10 detractors. TSMC is a very large part of the portfolio, a very large part of the benchmark, so it does account for a lot of the positive returns. But beyond that, you can see that it falls away quite quickly, showing again it's that balanced portfolio approach, diversified sources of alpha. Similarly with the detractors, there's not going to be one single company that accounts for all of the underperformance or any of the detractors. Again, it's quite a wide ranging amount. So that should give you a taste of how we run things. So yeah, I think that I'll stop here, and Joe, happy to take any questions that we might have.
Fantastic. Thank you, Long. That's a really, really strong update, I think, and hopefully gives everyone on the call a really good flavour to the trust and how you guys operate. But yeah, I think it's a great time to kick off some questions, and why not start with China? I know that seems to be a bit of a topic on everyone's mind at the moment. We saw China had a pretty significant bounce back in 24, but ongoing challenges, particularly that property instability and those geopolitical risks, which just seem to be the most talked about risks around China at the moment, have seriously dented that investor sentiment. And I know you've been to China recently, so perhaps it's a great point to start by giving us your thoughts from what you've seen on the ground, and perhaps where you're seeing direct opportunities. And by direct, ignore the developed market or off benchmark stocks, but those stock specific on the ground stocks in China would be great.
Yeah, sure. So it's a very big question. Maybe first thing to say is a bit of a disclaimer, which is, we don't have macro views. So obviously, I will not have a view on whether China will out or underperform this year and next year. So yeah, very little value to add there. But just to give you a bit more insight, looking at the property market issue specifically, which you mentioned, it has been very painful for China's economy as a whole, given how big that sector was. But really interestingly, so I've been doing emerging markets for 12, 13 years now. And at any point in the past, when you saw this kind of property market issues in China, you would have seen very quickly the government step in, create some liquidity, create some stimulus, and solve the issues. But of course, you're not really solving anything given the oversupply, given the indebtedness of the developers. All they were doing back then was kicking the can down the road. So yes, I think it's really painful, and I think it will take quite a long time to sort out. But I do think that they will emerge stronger from this with a much more balanced economy. I think in a way this is a necessary pain that they have to take, and it's encouraging that I guess that they have the courage to do it rather than kick the can down the road as they might have done in the past. But going on to kind of general sentiment and what I felt on the ground in China. So I was in China in January this year. I was in China a couple of times last year as well. Actually, it feels like sentiment has improved in China. So talking to corporates there, last year they didn't really know what hit them. Kind of came out of nowhere. But this year, I don't think anyone's predicting very strong recoveries or, immediate bounce backs. But definitely there was a sense, and you've seen it play out in the last couple of months, that things are not getting any worse. Right? 2024 was so bad that now you're at a very low base, and incrementally things are getting better. I think the other kind of thing that I really picked up on these last couple of trips to China was, again, historically, when you went to China and if you met a company where the industry was suffering or maybe the economy wasn't doing so well at a certain point in time, all the management teams would say is, oh, but we're not worried because the government's come out with this stimulus measure and we're just going to ride on the coattails of that and life will be great. But now, they're actually saying, okay, we think this is our strategy to get ourselves out of trouble. We can't rely on the government because it's not going to just give us another stimulus or another bailout. So you're actually seeing much stronger management teams. I think you'll see a divergence between better management teams and maybe the less good management teams. I think the better ones will have strategies to maybe grow their way out of trouble or find new markets they can open up. Um, I think that kind of leads on to the question where you're saying, where are we seeing opportunities in China? So where we're seeing opportunities as a team, they tend to be more domestically focused companies. So companies that are focused in niche industries, for example, so small industries where they tend to be market leaders, where maybe the market historically was dominated by a few international players, but increasingly the quality of the local players is either good enough or has actually surpassed in some cases the international players, and then they're undercutting on price. So domestic kind of substitution or import substitution is a very big thing that's happening in China. And given, I guess, how prevalent and how strong international companies were in China for a very long time, this is something that has a lot of room to grow. And maybe the last thing to touch on when we talk about China is DeepSeek, which is something that has been talked about a lot. I mean, I think personally, I think it's far too early to try and decide what DeepSeek really means for China and for the world. But I do think it's a fantastic reminder that China, despite what sentiment might have said about the country, it's still a very large country with a very large economy and a very talented workforce. So the level of innovation that you can find in a country like that just means that, it's something that we can never write off and say, it's never coming back or China's in trouble for the next decade. I think it was a good reminder. I don't think necessarily it is the signal to go piling back in anywhere, but definitely it was a good reminder that there is a lot of innovation that's happening within that country.
Fantastic. And I guess featuring across to India, you mentioned, unsurprisingly, that given that deep expertise in India, the portfolio is tilted more so. Given elevated valuations in recent years, are you and the team finding less opportunities that you're willing to invest in, perhaps because of those valuations? and therefore, you're trimming some of those holdings to lock in some profits and recycling elsewhere? Or are you still happy to invest in India given those elevated valuations?
Yeah. So in a way, it's kind of confusing because the answer to that would be kind of yes to both. So let me just qualify that a little bit. So India's valuations certainly look stretched relative to the rest of emerging markets, but it's worth remembering that a large part of emerging markets is China, and China's valuations have been very depressed for a while now. So that premium that India has over emerging markets, a lot of that is actually down also to China derating as an economy. India's valuations relative to itself. So if you take a very long-term history, it is elevated relative to its own history. But if you look at it since Modi's government came into power and really, turbocharged the Indian economy, it's actually trading relatively in line with where it has done since Modi took over. So we think that valuations are, yes, undeniably higher than the rest of emerging markets, but we don't think that they're eye-wateringly expensive, so to speak. But having said that, we think we will continue to find good ideas in India, given how rich that market is, and given that the small mid-cap space, especially where we have a lot of expertise, is very strong, and there are always good ideas emerging there. But having said that, we like great businesses at attractive valuations. So valuations does still play a very important part for us. So actually what you've seen maybe over the last 12 months or so is that overweight in India has actually come down a little bit, and actually China has grown in the portfolio. Now, again, we're not making country calls that China relatively looks more attractive now. It's just that from that bottom up perspective, great businesses, attractive valuations, we saw some of that capital going from India into other parts of emerging markets within the portfolio.
Okay, fantastic. I guess keeping on the country theme, are there any specific themes there that you think are positive or negative in terms of driving the trust? Because a couple of questions have come in about the impact of Trump's potential tariff plans, and also in conjunction with that, no Singapore exposure, which is a market that seems to have been less targeted with those tariffs.
Yeah, so actually Singapore is not part of our benchmark. So Singapore is actually a developed market, so not actually part of the emerging market benchmark. But we do look at Singapore time like once in a while, given that it does have exposure to, especially to the ASEAN region around it, which is very much a part of the benchmark. In terms of tariffs and countries, I think the last couple of weeks speak for themselves in the sense that it's quite unpredictable where the tariffs are going to come in, what degree they're going to come in at. So, yeah, I have absolutely no more insight than you do about what's happening next on the tariff front. But what I would say, though, is again, earlier this year is in China, but also in Korea. When you talk to the companies on the ground about Trump and about the tariffs and what trade might look like over the next couple of years, they are actually much better prepared than they were 4 years ago, or 8 years ago, sorry, when Trump 1.0 happened. So it feels like if you think back 8 years ago, a lot of the companies thought that, a lot of the corporate management teams believed that Trump was posturing and that it was, you know, not really going to be implemented. But to their shock and horror, it actually was. So there was a lot more panic when it did happen. This time, I would describe it more as calm resignation. So they did believe even before he came into office. So I was there in early January, that Trump would implement tariffs. They didn't know exactly how, to what degree, but there was a resignation that it would happen. So a lot of the corporates had actually been preparing for this, and by doing so, what they've done is they have more flexible manufacturing. So they have manufacturing across different countries. A lot of Korean corporates had actually opened manufacturing facilities in the US itself. Other companies were doing Vietnam, they were doing Mexico. Don't know how protected that will be, but at least it gives them some level of flexibility versus having 100% of production in a certain country or in China, for example. But the second thing that was quite interesting, especially Chinese corporates, since the last Trump administration, they've pivoted a lot to markets that are not the US and not the EU. So you've seen a lot of Chinese presence in the Middle East, in Africa, but also interestingly in Eastern Europe and also in Central Asia, so areas like Kazakhstan, for example. So I think this combination of trying to be more nimble with the manufacturing base, but also focusing either domestically or opening up new markets. I think that has helped them be a bit more resilient, but nothing. The US is still a massive market, so there will still be shockwaves and impacts. But at least this time it feels like there's a level of preparedness that maybe wasn't there previously.
Fantastic. And you touched on Korea a little bit there as well. It might be worth just running through your thoughts on that, because obviously we're aware of the Value Up program and some of the benefits that that's starting to have. But back end of last year, martial law, ongoing tensions with North Korea and indeed China, is that still an opportunity?
Yeah, we think so. We think, again, no view on Korea as a market, but we think that. So, okay, a couple of things to unpack here. Let's start with Value Up. We're not very excited about Value Up as a program because these top-down initiatives don't tend to have too much of an impact a lot of the time. So we met a company who unanimously came up with a Value Up program that the market unanimously said was a flat, boring program and no one got excited about it. When we met the management team, it turns out it took them 18 iterations to get to that. So, 18 iterations for something that's got nobody excited, it's not really worth, I guess, thinking about too much. So we still prefer to focus on fundamentals, follow the earnings and that Value Up. If the management team is a good management team, that should unlock itself. Now, maybe what Value Up does have the benefit of is we don't think it'll cause a step change in fundamentals overnight, but maybe it creates a better sense of corporate responsibility amongst management teams. So the idea that if you want to extract cash from your business, you should pay it out as dividends to all shareholders fairly, rather than extracting it just to your bank account, which happened many times in the past in Korea. In terms of the opportunity set in Korea and the, I guess, the upheaval that they had recently in terms of politics, Koreans have a culture where they've embraced democracy and they've embraced a very American form of it, I feel. So what that means is if you walk around Korea on any given day, especially around the CBD district, you will come across protests. And this has nothing to do with the presidential issues at the moment. If a company's shares have underperformed, a lot of the time you'll hear people outside the office of that company protesting against the management team and demanding money back for shares underperformance. Talking to a lot of the locals there, it turns out that a lot of these protesters are actually paid protesters. So, not something that they believe deeply in, but so I guess the point here is that protests seem to a large part be easily accepted by the market or by the public over there. So I don't think it's something that will cause significant disruption. But having said that, the longer it drags on, obviously, the more uncertainty that creates, and that's never great. But so far, I don't think the political tensions have really led us to be particularly negative on the companies there.
Okay, fantastic. Let's go a little bit more trust specific now. With a couple of questions come through on that. The trust launched kind of May 23 and since then has steadily grown, but is still relatively small in size. Are there any plans to grow the trust to a particular size? And I know this is a very difficult question to ask, but over what time frame perhaps?
Yeah, so obviously we would like it to grow and grow quickly. So I think if that happened, it would be great because it means that the costs get shared over a much larger base. So our clients actually will benefit a lot from that. As you know, we have tried historically with the Asia Dragon proposal, which unfortunately didn't happen for us. So I would say that we're always trying to grow the trust to help defray those costs over a larger base. Maybe the easiest thing to point to, though, would be our India Trust, which started at a similarly small size and today is a few £100 million big in size. So I think, as an investment team, as much as we would like to grow the trust, it's not something we can control ourselves. So instead, what we focus on is the page you see in front of you here, which is just performance. And we believe that if we continue to generate kind of peer group leading performance, hopefully the assets will follow, and hopefully then it helps all our clients with the cost of the trust.
And then in terms of that rating and appeal to clients, then how is it that you and the team manage your premium discount relative to peers? Because I know you've got a number of tools at your disposal.
Yeah, so probably the most important one is that annual redemption facility. So essentially, every year around December period, it enables any investor in the trust to exit their position, I think, at or around NAV. So if you know you have that coming in December, it will help to control the discount, hopefully, that the trust trades at. So we have the same mechanism in the India trust, and that on average has traded at a premium. And I think so has this trust. So hopefully that mechanism combined with continuing strong performance should be enough to see us maybe not sink to the discount that some of our peers have.
And in terms of gearing, then, a lot of peers in the sector use gearing for a number of reasons. You and the team have the option to employ a level of gearing, but haven't really since inception. It would be good to understand why that is, and perhaps, as I know this is something that you covered in previous webinars before, if it was employed in a market like India, why it would be beneficial.
Yeah. So I think a lot of our clients, sorry, not clients, a lot of our peers tend to use gearing to express confidence in the market sometimes to lever up and do that. So again, we'll never do that because we don't have the ability to call which way markets are going. So for us, gearing is very much like you mentioned for the India market. Because we have access to a lot of pre-IPOs and IPOs within India. With India, you have to pre-fund the IPO. And if you were fully invested in the trust, let's say, and you wanted to take part in an IPO, you would have to sell something in order to pre-fund it. However, the gearing facility allows us to pre-fund that position we want without having to sell something beforehand. So we can stay fully invested, but still participate in the IPOs. So for us, gearing is very much for that purpose and that purpose alone.
And on the IPO front, Long, you have obviously taken advantage of that since inception, and a number of those IPO opportunities in the India space have crept into the kind of top 10, top 15 over the last year or so. Would you like to kind of pick out one or two of those, perhaps just to bring some colour to the IPO process and how you go about finding them?
Yeah, certainly. So maybe the easiest one to talk about here is KRN heat exchanger, which, as the name suggests, they manufacture heat exchangers. So not the most, I guess, exciting business, but it was a very small business that had done very, very well, and it is run by a very strong management team. So when they came to market, it was something that was a very hot IPO, so to call it. But given WhiteOak's position in India, given the reputation we had, uh, we were able to secure for all the funds that we have a good position in that. And as you can see, 300% return since it IPO'd. I think, you know, part part of it definitely has to do with the team in India and the ability to identify which of these companies coming to IPO, so be it Care and Heat Exchanger, Dom Industries, which they manufacture pencils. But identifying the right businesses is one part of the puzzle. The second part of the puzzle, though, is very much being able to get an allocation that is big enough to make an impact. So again, benefit of a small trust at the moment is any allocation we get can make a very big impact on performance. The bigger the trust gets, the less each individual IPO will help. Um, so again, that's something that is working well for us at the moment. But that stream of ideas, that stream of IPOs, we think is something that will continue to happen.
Brilliant. Fantastic. And I think we just got time to squeeze one more question in, and I think it makes sense just to touch on the Opco Finco model a little bit more. I know that's quite integral to the process, and as you said, it's that kind of sophisticated cash flow model. So perhaps putting a stock example to it, we
Yeah,
might bring a bit of context to how that
yeah.
works.
No, definitely. So maybe I'll make this a kind of more UK focused example,
Mm.
but The easiest way to do this is, let's assume hypothetically that Sainsbury's and Tesco's were two identical businesses run in exactly the same way, except the only difference between the two is that, let's say Tesco owns all their assets. So they own the shops, they own the fleet of trucks, cold chain, logistics warehouses, everything, whereas Sainsbury's decided to lease everything. So if you were just to look at this on an accounting basis, so let's say you look at the operating margins of the business, because Tesco owns everything, they don't pay rent. So maybe their operating margins look better than Sainsbury's margins because Sainsbury's has rent coming out of that. So just on a pure accounting basis, you might say, oh, they're the same business, but Tesco has higher margins. So what that means is that Tesco management team must be better and they must be doing a better job than Sainsbury's. So Tesco deserves a higher valuation than the Sainsbury's. However, if you delve into it, like why that difference of margin is there, you'll see that it was a capital decision by the Tesco management team that has driven this. It wasn't anything to do with your ability to run a business. So we think that you shouldn't reward these businesses for something like the decision to buy a shop rather than to rent it, because in the long run, this isn't what creates value for a company like Sainsbury's or Tesco's. It's how well you run the supermarket. So the beauty of the OpCo-FinCo model is it normalizes for this. So for example, how we value these businesses is the FinCo is essentially the provider of capital to the company. So they provide capital for PP&E, they provide the working capital, and in return, they get paid a charge. Now, if you're providing capital, all you should get paid is the cost of capital. So in terms of valuation, valuing the FinCo is very simple. It's just 1 times book value from now till eternity, because all it does is earn the cost of capital. However, the OpCo is what they do is they actually generate all the revenue, and after they've paid off the charges to the FinCo for PP&E, for working capital, after they paid off taxes to the government, everything you're then left with is excess return. And now that is the valuable part of the business. So what we do is we forecast that out into the future with a DCF, put an exit multiple on it, and then you combine those two, and that gives you the value of the company. So the exit multiple that we put on it is probably something that is talked about and debated a lot internally. It has to do with a lot of things like the quality of the management team, barriers to entry, the rate of growth. So all these different things come into it. But essentially, you can see that what we're valuing is the excess returns of the business, not so much the assets and I guess, the provision of capital. So for us, OpCo-FinCo is a way to drill into the true economics of the business rather than pure accounting metrics, which can, as we outlined in that example, can be quite misleading.
Fantastic. I think, Lauren, that's a brilliant way to end there. And so thank you for providing some really good answers to those audience questions. But it does look like we've come to the end of our time. And for those listeners still on that want any further information on the Ashoka WhiteOak Emerging Markets Trust, then Long and the team publish a really good range of quality information, both on the trust specifics, but also broader market insights on the Ashoka WhiteOak website. We at Kepler as well will also be publishing a full note on that trust shortly, so stay tuned for that. So I just want to quickly extend our thanks to those that dialed in this morning. And I'd also like to say a big thank you to you for joining us today and providing a really, really good insight on the trust, but also offering your outlook on emerging markets.
Great. Thanks so much, Joe, and thanks everybody for joining in.
Brilliant. Well, that's all we have time for. So take care and bye-bye for now.